Oh, hey, how are you guys? Welcome to Capital Advantage Live SIE exam, Series 7 exam, Series 6, 63, 65, 66 live Q&A. And I still have no viewers. Wow. Okay. So, hey, Mr. Soccer Animal Ginger, how are you guys? Hope we're doing well. I hope everyone's studying. We have a lot of people. There's a couple of people out of here who won't be back anymore because they beat the beast and they're done. So that's your guys' next one. That's the next goal. You guys want to, Mark, how are you? That's your guys' goal, is to be done. So one day you get on here and go, hey guys, I'm done. I'll never be back. Okay. Yeah. Was that you who put it in, or you just read it? I did explain it. So Mr. Soccer Animal's asking, can I, Sharona, there we are. Sharona is done. Done. She was nervous the first one. She wasn't nervous on the 63. And I'll get you a Soccer Animal. Hey, Cynthia. Congratulations, Sharona. I mean, everyone's in. Everyone say snaps for Sharona. Anna, how are you? Okay. So forever and ever, everyone to know Sharona passed. Okay. Now, Mr. Soccer Animal. So on Reddit, somebody asked a question. Can I explain, Greg? How are you? Everyone, Greg, say congratulations to Sharona. Everyone, okay. So now, on Reddit, they asked a question about what was the best investment for a person with a young child who, I think if I remember right, they have 18 years till. Oh, Anna, I know we got this. You're gonna get, after this, you're gonna get some sleep and you're gonna go. So they asked a question: what was the best suitability for if you have somebody who's going to school in 18 years, if you have a child? Shashi, how are you? So now, the question became, and there's a bunch of things like, corporate bonds, this and that, and they're going back and forth. And the answer, you have to understand, FINRA loves zero coupons, okay? So Angel, the question, there were certain choices. Allie, how are you? Okay. So the choices, there were 4 choices, and one was equity, one was this. So the best choice was a zero coupon, because they said, if you remember, they said they don't care about market conditions. But here's the thing on this. Kirsten, we're going to nail this thing, right? We're going to get this. Okay, so now, I wonder if this is Sharon, if this would be the last time you're on. I mean, it is 8:30 at night. You have more things to do. My question is, Mark, how are you? Sharon, how drunk did you get after you took it? So back to this, Mr. Soccer. So what happens is that they believe that if say you have college for 10 grand, good and drunk, I love it. That's what you got to do for the next week. Just enjoy it. And then you come on when you make your first million. Okay. So now, if you invest, say you buy a zero coupon, a strip, a long-term zero coupon, you buy it for like, $600. Gabby, how are you? So buy it for like $600. In 18 years, it'll be worth $1,000. So the whole point is, you go, oh, I need $10,000. Okay. Yep. So say I need $10,000 in 10 years. I know that if I buy $10,000 worth of zero coupons, if I buy $10,000 worth of zero coupons, the face value, and I pay $6,000 for them, I know for a fact that in 8 years or 10 years, or whenever I buy it, it's going to be 10 grand. So FINRA loves zero coupons for college savings. I disagree, but that's what they do. Remember, they also started this in the 80s when they started doing this stuff and talking about it. Interest rates are, 14, 15%. So it worked. You could buy a $1,000 zero coupon for like $200. But their idea is that if you don't care about market conditions and you put it in a retirement account or a Coverdell or something like that, you pay no taxes on while it's growing. But they are big on the zero coupons. Okay, that's just the big thing they love. Judy, guess who's out to dinner on my gift certificate? No, I'm going. They're not going there. I'm going tomorrow because today's my anniversary. Okay, so now, Soccer Animal. That's the point. Is that every time, whenever you see college savings, they always want zero coupons because the point is it's guaranteed. Okay, that's the thing on this, is that it's a guaranteed number. I need money for my kids. I need $30,000 for my kids' college. I know I'm going to buy $30,000 worth of strips but I'm only going to have to pay like, 18,000 for them. But I know that they're going to mature this summer or the summer before he goes to school or she goes to school, and I'll have the money. That's the point of that. And the key thing is, as a person said, not to deal with, they don't care about market conditions. Okay. Now, thank you very much. I think it's 31. My wife's card said we're at the point now where we don't even know what the years is. Okay. Well, I know she's out to dinner with my daughter, so it's okay. Okay. So your accretion thing, I'm gonna get you. Okay. Colleen, how are you? Look at you, I'm back on. Okay. So Gabby, the point is they're referring to that a lot of times. Sure, I'll do that. So a lot of times when they're talking about what their register rep can and can't do, and I promise to get the accretion at some point in a minute or two. So when they're talking about what the register rep can and can't do, the point there they're saying is that, what can he do? Can he, Arlen, can they post, like you said, can they post on social media? Can they do a trade without discretion? Can they do, what should they do if this happens? Robin, hey, Dave, how are you? Thank you. So stuff like that. So it's more about what he's allowed to do. And this is what I tell everyone. If it ever says, what should the RR say? It is always some sort of downer. Hey, Bert, it is always some sort of downer. Thank you, Robin. Like a question I got, Chad, thank you. I am sorry about that, Arlen. I'm really sorry. That's really sad. I apologize. I'm sorry about that. So, like I got a question or saw a question referring to day trading. What should you tell a person who wants to day trade? Okay. And there was some things like, yeah, you can make money, you can't make money. But the actual answer was day trading is not for moderately experienced investors, because day trading is risky. Or like somebody had a limited partnership and they said, are they liquid or marketable? And one of the answers was, yes, they're active. That's an answer. But the second one, the better answer was, yes, they're marketable, but past returns don't predict future. So it's always whatever the register rep can say would be some sort of downer. Maybe another thing like, can a register rep do a trade? What if you call up and say, what if I call you and say, I buy 100 shares of Apple at 130, and then now it's at 125, and I go, I don't want the trade anymore. What do you do? Just in case. And you may see a question like that. So I call you up and say, buy 100 shares at 130. An hour later, it's trading at 125. I go, well, maybe that was a mistake. I don't want to own it anymore. So what's going to happen is you go tough. You own the stock. If you want me to sell it for you, I can, but you're going to take a loss. You can't change your mind. And that was definitely a question. While I work up to the accretion, duration, all duration is for these exams. Yeah, if you want to talk to a CFA thing, that's fine. Duration is volatility, how volatile the market is. So really long-term bonds, low coupon, have more duration. Really, the definition is how long it takes to repay itself, meaning get the bond. So if you have a low coupon, it's going to take longer. Like if you have a 20% coupon, it'll take 5 years to get your $1,000 back, $20 a year. Okay. Or $200 a year. If you have a 10% coupon, you're getting $100 a year. It'll take 10 years to get your money back. So that's a longer duration. So duration is really about the volatility, but the real definition is how long it takes you to get your money back. So that's like in a zero coupon. You're not getting anything during the life of it. So it takes you the entire maturity value to get your money back. Okay. The battery's dying. My computer is getting low. Hold on. I don't want to die on us. That would be bad. That would be really bad. Okay. So now, let's hope I do this in time. So now the next part of this is unplug. We're plugging in. Now, you asked about accretion. Okay. I hope that helped, JC. Duration is just volatility. So the longer the bond or the lower the coupon or the lower the price, the more volatile or the more duration it has. So what she asked, accretion, are you tripped up on accretion? Okay, so it's really the same thing. So think about it. They're both the same thing. Accretion and amortization. The first step you do is distance from par. So if it's a $1,200 bond, it's 200. If it's a $900 bond, it's 100. It's the distance from par, whatever that is, up or down, doesn't matter, divided by the number of years to maturity. So if you have a $1,200 bond and it's 10 years to maturity, $200 divided by 10, that's $20 a year as you're amortizing, because premiums amortize. And you're reducing the cost basis every year. Okay? If you have a discount bond, let's say you have a $700 bond and it's 10 years to maturity, it's $300 discount divided by 10 years. That's $30 a year you're adding to the cost basis. So remember, you're adjusting the cost basis up or down. And then what happens is if you sell the bond, so let's say you have a $1,200 bond, 10 years to maturity, and 2 years later you sell it, okay, for whatever price, we'll come up with it. If you have a $1,200 bond that's 200 years to maturity, $200 over par, I'm talking too fast, 10 years to maturity, 200 divided by 10, that's $20 a year. After 2 years, it's dropped 40. So now it's an $1,160 cost basis. So if you sell it for more than $1,160, you have a capital gain of 20 or 30. If you sell it for less than $1,160, then you get then you have a capital loss. So you're just adjusting the cost basis. Amortization adjusts down, accretion goes up. Now remember, OIDs, an OID you must accrete, right? So if you have a zero coupon OID, you have to accrete regardless of the bond. If it's a muni, that shit's not taxable. A treasury is taxable in the federal, not the state. A secondary market discount bond, you don't have to accrete. You can do cost method where you don't have to. On a premium bond, munis must amortize. Remember that. Munis must amortize. Corporates and treasuries don't have to. Ginger, I hope that helped a little bit. Okay. If you like what I'm doing, please hit the like. Okay. Okay. And if you know somebody who's struggling, send them my videos. Okay. So now, okay. Jay, awesome. Wow, look at you. Look at you nailing everything. Okay. Okay, I'll talk about the repo in a second. It's not really a big part of the test, but I'll talk about it. Okay. Okay, good. I'm happy it helped. Okay. Okay. Yeah, Arlen, I'm going to tell you right now, if you have stuff going on in your head, do not try to do this while you're upset. So if you're really upset, if you're close to your uncle or something like that, wait till that's done and then book it. Don't try to do two things at the same time. I just think you're not fair to yourself. And then you do the Gabby, you're going to nail this thing. I promise. Okay. Okay. Thank you. Happy anniversary. I love it. Okay. So now, okay. Jay, I'm so happy for you. Remember, for the 63, make sure you read. That's the one exam that I'm actually okay with you taking a lot of tests, because timing is a thing. Timing is an absolute thing, Jay. So anyone taking the 63, timing is an issue on the 63. That's kind of the only one that is. So make sure you get down your time. Try to get it where you can take the exam in under an hour, the practice ones, so that when you're there and you realize these paragraph-asked questions are hitting you, you'll be okay. 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 Repos and reverse repos, what you need to know for this. Okay. Okay. I hope that, Ginger, I think that did help. Okay. So, okay. Yeah. Okay. So let's go. Yeah, Chad, I know you're going to get it. You just keep at it. Okay. So where are you? Greg. Okay. So repos. So understand the repo market. This is what you need to know for the test. What does the Fed do? Okay. So remember, whoever is doing the repo is doing the buying. It's really a repurchase thing. But what happens is when the Fed is trying to loosen the market and make it better and lower the rates and increase liquidity, what they're going to do is they're going to buy treasuries. They're going to do repos. They're buying treasuries from the banks. And then the banks will end up buying them back a little bit more like 2 days later. So a repo is a repurchase agreement. I buy it from you, and you promise to buy it back from me 2 days later for a little bit more. But in effect, I've lent you money for a couple of days. Okay. Okay. Yes, you did, Greg. You hit me up last night with that. So now, the repo market. So if we're doing an expanding market, what's the Fed going to do? They're going to tighten. Okay. So they're going to do reverse repos, which is selling treasuries, and they're going to raise the discount rate. The only two things they can kind of do. Okay. During contraction, they're going to loosen. Okay. So what they're going to do is they're going to buy bonds from the banks to give them money, which is repos. And they're also going to lower the discount rate. So that's where you have to go. Just keep in mind that technically repos are money markets, even though they're not really a physical thing. It's just buying and selling treasuries. Okay. Okay. Okay, so REITs could invest in mortgages. Like they can remember, they have to be certain. Eddie, how are you? Okay, I'm so happy for you. I think you're done, Eddie, right? You're done with everything? Okay. Okay. Yeah, distressed is high yield. It's like anything in trouble. Like you have distress, Like if you have people distress like jeans or something like that, that means you're making it worse. Okay. So distress means you're sort of in trouble, bankruptcy or something like that. Okay. Now, okay, mutual funds. Remember, mutual fund is a package. I have to figure out how to do the live through like WeVideo or something. So that I can put shit on my screen. One day will figure that out. I'm just so busy teaching that I don't have time to work on this. So one day I'll figure out how to actually. I have a guy I'm meeting who's a tech guy. I think I'm trying to bring him in as a partner. Eddie, I am so happy for the done it. You can breathe again. Sharona is done. We're all going to be done. Eventually, in a couple months, everyone on this list is going to be done and not worry about this. Okay. So now, a mutual fund is a pooled asset. Okay. So it's a bunch of shit, right? So I do this. Pretend this is full of securities. Okay. My Diet Coke. I'm waiting for my Diet Coke sponsorship. So now, Diet Coke, this can is filled with securities. The only thing, if you have money and you have tech skills, okay, so now, if I'm kidding, Colleen, talk to me tomorrow. So now, if we have a mutual fund, this is full of securities, there's only really two things that move the NAV. If the assets inside the fund go up or down, then the NAV goes up or down, okay? So if the assets go up or down, say this owns Tesla, Apple, Facebook, all that shit. You're buying shares of this, not the stuff inside. So what happens is as the assets in here go up, the can's value goes up. And it goes down if they go down. It's not about when they sell them or anything. It's on a daily basis. They check the prices and the value goes up or down based on what's in here, okay? The second reason NAV would move is if this mutual fund pays a dividend to the investors, not if they get a dividend, because remember, if they get a dividend, the price inside drops for the same amount they get cash. So it doesn't matter because you're going to get cash that equals what the drop is. So there's only two things that affect NAV. One is the assets going up and down. And then if the mutual fund pays a dividend to you, the market price, the NAV is going to drop by the amount of that dividend. Those are the only two reasons. It's the only way NAV goes up. Assets going up or down, or if they pay a dividend. Not if they receive, not if they sell the shares in there, not if you redeem, not if you buy. I hope that helps. Okay. Now, yeah, okay. So Gabby, retail communications is pre-approval. Other than a public appearance and chat rooms and interactive stuff. But yes, retail communications is pre-approval. Boom. Okay. Now, secondly, correspondence is 25, sending recommendations of 25 or less. It's reviewed, not pre-approval. It's reviewed just like institutional. Like, that they read your emails, like 5 to 10% of your emails and all that stuff. That's the review they go through. If you guys are trained, like they give continuing ed on that, they all of a sudden, with the correspondence and the institutional, they don't need pre-approval. They can actually just review the fact after. Okay. Now, sinking fund. Okay. A sinking fund is usually for revenues, not for geos. It makes you feel better. So what happens is, if it's a sinking fund, I'm a revenue bond, and maybe my coupon is like 7 or 8%, or for some reason, part of the indenture or whatever it is going to say we have to put a sinking fund. Okay. So what happens is we're not putting accrued interest in there. What we're putting in there is money that we generated. So we're putting some of our revenues from the project into a escrow account, which is like a legal account, account set aside where we put money aside during the redemption protection. If you remember what redemption protection is, that's the number of years that you cannot call the bond. So we're gonna do it the whole time, but where we really build up the money is every year we're putting like $1 million or $500,000 or $2 million into an escrow account to call the bonds at a later date, and that's what it is. That's why we're doing this. Okay, so we're doing this to put money aside to call the bonds at a later date, and at first you think that's maybe not a good thing, but it is a good thing. Okay. What it's saying is that, yeah, we'll get to it. So I'll tell you that, John. So now, okay. John ripped through them all. I think he got all. I think he took life and health and everything. Okay, so okay. Sinking fund is more for the 7, but it could possibly be peripherally on the SIE, but I highly doubt it. This is more for the 7. So the sinking fund is money put aside. And remember, guys, even if you're taking the SIE and they're taking the 7 after, this stuff is kind of good to listen to, so you're ready. You'd rather be over-prepared than under-prepared. So the sinking fund, boom, I'm putting money aside to call the bonds at a later date. That's the only way they were for. Okay? Boom. I hope that helps. Okay. John had a question that said, what is maximum contribution to a 529? 529 without being subject to gift taxes. So here's the deal. So you can get 15 grand a year, but you can preload 5 years. There's the trick, right? So you can preload 5 years worth of gifts into one, okay? So what happens is, Cynthia. Okay, so now, how'd you do? Well, you can even text me. I don't know how you did. You gotta, the first thing you do is you write down everything you remember from the exam to put it in a drawer. Back to this, gifts. You can give 15 grand a year anyway, so you and your wife can each give 15 grand a year to the person. So the point is you can give 5 years worth up to 75,000 each. Boom. Okay. So that makes sense. I hope that. Okay. Now, 5 years, you can preload it. Now, can you give more than that? Yes. Okay. Okay. Cynthia, let me explain something to you. There's lots of people who fail at the first time. Okay. A lot of people do that. A lot of people take it more than once. You'd be very, very surprised how many people have taken it more than once. The 7 is no fucking small feat. It is a son of a bitch of a test. It really is. Okay. Okay. And as I tell everyone, it's a 30-day problem. Maybe you could take the 63. There you go. So certain people, I mean, I have one girl I worked with, she wasn't a student of mine, but I knew her from before I started teaching. She took it 12 times. Her job wasn't on the line. She just wanted to take it. And what's funny is that she took it, and then 2 months later, boom, she ended up leaving the business. She owns a deli down in Mystic Island or whatever it is, in South Carolina, whatever it is, Myrtle Beach, Mystic. Yeah, that's what I'm saying. These are new things. Okay, people aren't in finance. It's sometimes you're pressured to take it before you're supposed to, so stuff like that. Okay. Yeah, don't sweat this stuff. Okay. You don't sweat failing. It is such a small freaking thing in your life that it doesn't matter, because all they care about is when you're done is get through that door, get past the test. 2 years from now, it'll be a happy memory. You'll be like, wait, was there a video I used to watch? Stuff like that. You won't remember any of this. Okay. And just remember, focus on adding knowledge more than, okay. Yeah, Bert, we're going to nail this. Okay. When are you taking it? I forgot. Okay. Okay. Oh, you're killing me, Greg, with all this. Okay, so now, I'm not going to go too heavy into the CMO stuff, but understand. So what happens is we have CMOs and then we have PACs and tax and stuff like that. CMOs are mortgage-backed securities, which I've done on a few of these already. Okay, so look at that. It is Colleen using my shit. 30-day problem. So now, CMOs are mortgage-backed securities. They have prepayment risk. Prepayment risk is the risk that people refinance the mortgage before you want them to, so you get money back soon. So that's a regular pass-through certificate. The CMOs kind of diversify that out with the different tranches, which I can always go over. Maybe I'll try to do a video on that. I say that, but that's just, this is a Series 7 thing. So if you're SIE, kind of just go to a cup of coffee or something. But the CMOs, the mortgage-backed securities, they get monthly income, but the CMOs, they split them into tranches, okay? So what happens is the tranche A gets paid off before tranche B, C, D. So what happens is there's still prepayment risk. And I'm going to do this another night. I'm not really doing it justice. But the whole point here is that, okay, we have prepayment risk, But what happens is if you make it a pack, so what you're doing is, I wish I had the circles. You have a CMO here, and you add companion tranches onto it to reduce the prepayment risk of the CMOs. So what happens is the safest of all the mortgage-backed securities is a PAC, a PAC. The PAC is a mortgage-backed security with the least amount of prepayment extension risk. The next one is the TAC, a TAC, because it only protects against prepayment risk, not extension risk. Extension risk is the risk that people don't refinance and you're stuck in the stupid thing for a while. So it goes PAC, then TAC, then CMO, and then Ginnie Mae pass-through certificates. So safest, most secure, most reliable answer of when you're going to get your money back is a PAC, then a TAC, then a CMO, and then a pass-through certificate. Okay. Yeah, that's perfect. You either pass or don't pass. It's not a fail. Okay. Okay, by the way, so the 65. Okay. So Jake, are they oh, you have the 6, that's why. So look, the 65, there's going to be some overlap from the SIE, some overlap from the 63 a little bit, but it is a different beast. It's a long test. It's 150 questions. Okay? Okay. Did I miss any questions? Like I said, oh, by the way, in a Z tranche, just so you know, a Z tranche, I don't even know why anyone would buy it, but it's a long-term zero coupon tranche. Okay. 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 The Z tranche is a zero coupon. It's the last tranche to be paid. Boom. Out of all of them, it's the last tranche to be paid. Okay. Okay. Now, so Greg brought up arbitrage. Arbitrage is when, in reality, alone, arbitrage is this. Okay. Okay. So arbitrage is when you buy in one market and sell in another at the exact same time to capture a difference. So like almost like this. Like we know that people, when new phones come out, okay? When new phones come out, like Apple phones, people in China will pay a shitload for them. So technically you could do this. You could stand in the Apple store and have your friend in China with both on the phone. And as you're buying the phone for $800 here, you're selling it for $1,500 at the exact same time in China. That's sort of arbitrage. You're buying and selling to make a profit at the same time. Back when I first started, they had multiple exchanges, okay? Okay. Here's what I'm going to tell you right now. Chad, focus on the SIE and the 7. Stay in the moment. Don't worry about the 66. It's just a different animal. Stay in the moment. Okay. 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 Now, let me go back to this. So arbitrage, in arbitrage, when I was younger, would do this. In New York State, IBM's trading at $30. And on the Pacific Coast Exchange, it's trading at 31. What we would do is we would buy it here in New York at 30 and sell it short at the exact same time in the Pacific Coast at 31 and capture that dollar. Because if I buy it here and short it, not like a second later, at the exact same time, short it here at 31, buy it at 30, and then I make $1. That works with convertibles. What you could do is buy the bond. If the bond is convertible, which means it's profitable to convert, which we've done. So if the market price of the common stock is above parity and it's a profitable convert, what you could do is buy the convertible bond at like say 102, and then short the stock. Say you short $104 worth of stock, and you can make the difference. So keep in mind, they're not going to make you do the math on this. If it would be profitable to convert, or if you should convert, convertible arbitrage is a thing because you can buy the bond and short the common stock at the exact same time. So that's what arbitrage is, doing two things at the same time. Remember, it's not the same as arbitration. Arbitration is when you and I have an argument and we go to binding, non-appealable binding arbitration. Not the same thing. Okay. Okay. So cost basis. Okay. 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 So now, yeah, that's true. Arbitrage is totally legal. Okay. 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 So Kirsten, that's a good question. So I'm going to hit the cost basis for you in a second, but Kirsten, SIE, remember this. So remember these, okay? Buy a call bullish, buy a put bearish, sell a call bearish, sell a put bullish, okay? You buy for speculation or insurance, and the only reason you ever sell a fucking option ever is for income. So if you hear income on options, you know it's a sell. Boom, at least then you got a 50-50 shot. Income is selling, selling is income, income is selling. Now, I want you to write this down, Kirsten, for the exam. If it's not on this one, it'll definitely on the 7. If you are a long stock, there are only 2 options you can do, and most people have heard me say this. Sell a call if they say income or generate cash. Buy a put if they say hedge or protection. Again, if you're a long stock, you can sell a call for income or generate cash, or buy a put for protection. There are no other choices. If you're short stock, you can buy a call for protection, which is bullish, or you can sell a put for income or generate cash. So again, long stock, write it down. Long stock, buy a put, sell a call. Those are only 2 choices. Short stock, buy a call, sell a put. On the SIE, that might be 1 question. On the 7, just knowing that's probably 4 or 5 questions. Just knowing that. Okay. Okay, so when you buy stock, okay. Oh, by the way, best perfect are ass kickers. If you say you're failing like 71s, I wouldn't worry about it. Okay. Yeah, remember something. If you're doing past perfects for the SIE and you're passing, you're gonna nail it. Okay. Yeah, I think the SIE is definitely doable. It's not an easy thing for people who are not in finance, but if you got to know your risk, you got to know the regs, and you got to read. Okay. So what he asked about, okay. So here's what happens. So if you buy stock and you get a dividend, that doesn't affect your cost basis. That doesn't. But if you buy more stock with that dividend, then you are buying more stock, and then your cost basis gets adjusted. Because if you buy stock at 50 and then you get a dividend and you buy more stock at 52, your cost basis is going to be somewhere in between the two. Now, the other part is if you don't mention, say you sell your stock, this is SIE into 7. Remember, if you sell your stock and you don't mention a method, they use FIFO, so they're going to use the first price you bought. If your job is to do what they call select a share or share selection or share choice, okay? You want to choose what shares you're selling. Sometimes I ramble, I apologize. But the point is, if you buy stock and then get a dividend and then you buy more stock, your cost basis will go up or down depending on where you bought that stock. Because say you bought stock at 50 and then you got a dividend and bought more at 49, you're lowering your cost basis. But if you buy stock at 50 and get a dividend and reinvest that, and you buy it higher, it's going to be more, okay? So that's the way it is. I don't think you're going to do the math on the SIE. I really don't. But here's one thing. There are 3 things that do not affect cost basis on their own. If you're long stock, if you sell a covered call, does not affect cost basis. 2, getting a dividend does not affect cost basis. If you reinvest a dividend, then that action affects your cost basis because you're buying more stock. And the 3rd thing is accrued interest does not affect cost basis. So if you buy a bond, you get accrued interest, your price is your price. Okay. What happened to your former employee, 401k? Okay, so you could technically, and I don't know what the question is, Colleen, but technically if your 401k is at your old place, they can leave it there, but you're not supposed to do that. I mean, you're allowed to, but you're not supposed to leave your stocks you're not supposed to leave your 401k at the old place. It just creates some problems. There's no rule against it, but just don't ever fucking do it. Move it into a rollover. Don't convert it to cash, right? Well, you guess you can, but take the money, roll it over into, are you saying move it in? Oh yeah, I don't know that you can change the shares. You got to sell it out, right? And move it into an IRA. That's a good question. Okay. Good. Hey, Sal, congratulations. So happy for what's next. You have life and health maybe or no? Okay. So Mike Melrose. So now here's the deal on this. So, right. So arbitrage is tiny, but what happens, let me handle Mike again. Okay. Jake's right. Just have a basic understanding of options. But Mike, here's the thing. Past perfect is an ass kicker. They really are. So their questions here, you have to break it down. If you're failing because of their math problems, then you're fine. Okay. If you're getting like 68, 67, 69, 70s because of their fucking math problems, then don't worry about it, because the test is not like that. I truly feel the math problems are actually the easiest part of the test. It's the suitability ones where it's like vague and you're like, well, I don't know what I'm supposed to do. Those are the harder ones. I truly feel if they ask a math question, it's probably actually a very straightforward question. But Past Perfect does ask really, 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 really hard math questions, like enough where they say in the answer, this probably won't be on the exam. And I keep saying, then why are you asking it? Why are you wasting our time? It's a very frustrating thing, Mike. It's true. Just as you're doing exams, try to learn from it. If it seems really confusing, like if you get one of the questions on Past Perfect wrong because you have no freaking idea what they're asking, that's probably not a thing. Like if you understand the concept but couldn't understand what they're asking, that's really not the test. I'm not saying the test doesn't have some confusing questions. For the most part, you will always know what they're asking. Whether the questions work or not, I don't know. I hope that helped, Mike. Okay. Shot, you're right. Arbitrage is the buying and selling two markets. Since everyone's computerized, the margins have gotten down to really like almost to a penny. When I was a kid, yeah, buy for protection, sell for income. When I was younger, when I was 20 years old at a hedge fund, we did risk arbitrage and we were making mad fucking money because it was all hand done, hammer and chisel on our papers. So the spread was pretty wide. Okay. Hold on. Okay. Hold on. Boom. Okay. I do think you need to know for 7, absolutely fucking need to know break evens and stuff. For the SIE, you need to know it, but really you're talking 1 or 2 questions. If you're really struggling and you're taking the 6 next, do the best you can. Most places have a box chart that you can write the break even in. Remember this, when you have an option, if you buy a call or sell a call by itself, it's strike plus premium, that's break even. If you buy a put or sell a put, it's strike minus when they're by themselves. It's that straightforward. Buy call, sell call, strike plus. Buy put, sell put, strike minus when they're by themselves. There's no stock position. Okay. Yeah, 71, Sal, you're right. 71 is probably the worst score possible because you know your shit. Then you start doubting yourself. Then you nail it the next time. Okay. Yeah, that's true. The cheat sheets, I tell everyone to Google Series 7 dump sheet. It's not that you're going to use theirs, but it gives you ideas. You go, oh, wow, that's a cute little triangle or this or that. Just make sure it works. Okay. You're getting mid 70s. I think on Kaplan stuff, I think you're probably fine. Here's the thing, okay? If it's because you're memorizing answers, then buy another vendor and see what you do. If it's because you're seeing new questions and you're getting mid 76s, and the reason you're not getting an 80 because there's stupid mistakes, then you're probably going to be fine. And that works. Like if you guys need another vendor, Achievable down on my link has some good. It's like cheap and you can buy the questions. If you need a vendor, I got STC down there and you can buy that too. And I think they're solid and you get a nice 15% discount. Okay. Yeah, remember when they awesome, Mike. So remember something. I agree that you'd want to be in the 80s, 82 to feel really comfortable. But the thing is, you have to look at why. Because you can get mid 80s and fail if you're memorizing answers, right? But if you're doing it and you know your shit and you just made a stupid couple mistakes, because remember, on the SIE, the difference between an 80 and a 76 is 3 questions. So that could be 3 stupid things that you're just making a mistake on. So keep an eye on why you're getting 76s. Is it because you don't know your shit? Then it's a different story than if, I read it wrong or I did the math wrong or whatever it is. Okay. Remember on spreads, right? So remember this. The name of the spread is based on what's different. So like if you have 2 different on a spread, it's buy call, sell a call, or buy put, sell a put, right? Okay. If the strikes are different, it's a vertical or price, okay? Or money. If the months are different, it's a calendar or horizontal or time. If they're both different, it's diagonal, okay? But that only works on spreads. So if you see buy a call, sell a call, that's a spread. If you see buy a call, sell a put, that's a spread. If you see buy, call, buy, put, 2 buys in different options or 2 sells in different options, then it's a straddle. Okay. 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 Yeah, just get, okay. Okay. For bond purchase, okay. Okay, I'll slow down. Okay, hold on. There we go. It's just a damn, okay. Yeah, Mike, remember something. Don't overthink the freaking muni stuff, because a muni is just a bond issued by the state. All the other rules apply. It's a coupon and all that. The big thing you have to know is the suitability part. Know that there's 2 types. There's GOs, and I have videos on this. Watch my videos on the GO and revenue. That's your best thing. Who's texting me now? I got to make sure it's not my wife saying, hey, help me out. Okay. That's funny. Okay. I have a lot of political friends. Okay, so now, okay. Q&A, I don't know. I've done the Series 7 suitability, the video. I can try to do another one, but some people said it's pretty good. Okay. 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 Yeah, they're going to get 1 math question on the test. Okay. Okay, Gabby, final thing. Do not do any tests tomorrow. No tests tomorrow. Tomorrow is about adding knowledge, adding knowledge, adding knowledge. If you're taking the test, the day before should be no exams. It should just be straight up reading. That's all it should be. Just read, 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 add knowledge. If you have STC, get the crunch time facts down. If you have Kaplan, I think they have trending topics. If you have Notman, do the class summary. Those are big. Okay. Okay. Yeah, again, anyone who's using Past Perfect, if you're passing those things, you're in good shape, because those are fucking hard. Like, I'll explain it this way. I'll get 1 wrong on the actual exam, and I'm scoring the mid-80s. Maybe I'll hit a 90 on the Past Perfect stuff, but I know my stuff on the real exam, I get 1 or 2 wrong, and that's usually because I went too fast. So if I can bang out basically a perfect score on the real exam and only get mid-80s on Past Perfect, feel okay. That doesn't mean that if you're getting 70s, you're going to get an 80, but take it with a grain of salt, okay? Same thing with Kaplan. They're all solid. Kaplan, Notman, STC, Achievable, Past Perfect, Training Consultants. Those are the names that are solid. Okay. 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 Keep reading and focus on data knowledge. Okay. For bond purchase or premium discount, how's yield to call? Okay. I don't know what that means. So, yeah. Okay. So here's my thing on the bonds, right? So if you have a premium, so you got to know, it depends what test. If we're talking about the SIE, know the chart, right? Know that if it's a premium, it's coupon, current, yield to maturity, yield to call, and you quote yield to call. If it's a discount, coupon or nominal, current, yield to maturity, yield to call, and you're going to quote yield to maturity. You always quote the lowest of the yield to maturity, yield to call. So discounts, you pretty much quote yield to maturity. Premiums, you pretty much quote yield to call. So you have to do, so what you have to, what I was going to say, you have to know that order, whether it's discount or premium. Okay, that's the big thing. Okay, and you have to know how to do current yield. The portfolio analysis, okay. Okay, Greg, we'll talk about that tomorrow or something like that, okay? Okay. Because we have to, there's a couple of things. If you issue stock and at the same time you own an option contract, yeah, because I'm going to make it real quick. I'm not going to do the math on it, but I'll show you, okay. Portfolio analysis questions. How many equations? Here's the thing. You could try to learn all of them, but here's what I tell you to learn so you cover your bases. Learn earnings per share, learn PE ratio, learn current ratio, learn the quick ratio. Those are the main ones, okay? Those are the big ones. Maybe know net worth, which is total assets minus liabilities, and know working capital, which is current assets minus current liabilities, and know that when you declare a dividend, you raise your liabilities, so your net worth and your working capital go down. But when you pay the dividend, both the assets and liabilities go down the same amount, so your net worth and working capital don't change. Know that shit. Okay, you do need to understand what portfolio analysis is, the fundamental. The technical, I'm not saying just as trends and patterns, but that's what you have to think. that it's about trends and patterns and support, head and shoulders, saucer, all that stuff. But again, they're not making you predict a price. They just want to make sure you understand the difference between fundamental and analysis. Okay. That's fine. So here's the thing. So, Shah, yeah, I mean, if you're taking the SIE now, don't worry about the options too much. Really, I'm telling you, I'm not telling you to bail on the options, but if it's really, if it's really, really, really driving you nuts, the options for the SIE, let it go. Focus on the rules, focus on the regs, focus on the risks, because you're going to get maybe 2 questions, and I'd rather you get 5 or 6 questions in another topic than try to get that one option question, which is going to be so freaking basic. It's going to be unbelievable. Okay. 31 years. Okay. So again, now when a company issues a stock dividend, what happens to your option? You will not get more options. You will get more shares in the option. So if they do a 10%, say you have remember options are 100 shares each. So if you have one option contract and they do a 10% dividend, the amount of shares in your contract go up to 110, okay? That's what it is, okay? So the big thing is, in an option contract, if there's a stock dividend or an uneven split, 5-4, whatever it is, you're not getting more shares. You're not getting more contracts. You're getting more shares in the contract. So I tell everyone, this is what you do. Figure out the total value. So if you have a 50 call, that's actually worth 5,000 because it's 100 times 50, and that won't change. So leave that 5,000 out there, the 5,000. If you then get a 10% dividend, you do, okay, how many more shares am I getting? So I'm going to get 10% more. So I now have 110 shares in the contract. So then I do 5,000 divided by 110. That gives me whatever the price is. Say it's 45, whatever it is. So that's the best way to do it. Remember, the value doesn't change. Okay. Yeah, so that I tell everyone, oh, hold on. Disgorge. Okay, so let's talk about that. Okay, thank you, Carolyn. Okay, so now, yeah, so by the way, yeah, Bert, get that seesaw down, get the triangle down. It's like, remember this. I think, Bert, I don't know if we did this or not. So look, I have a triangle. I don't do the seesaw. I do the triangle. Here's my triangle. On the left side, discount. I go, I don't know if it's left for you guys. Coupon, current, yield to maturity, yield to call. And then it's always left to right. Coupon, current, yield to maturity, yield to call. And then on my premium side, I do coupon, current, yield to maturity, yield to call. Just get that down and it'll help you. Okay. Ian, I'm telling you right now, no, I wouldn't worry about that. If you're taking the 79, yes, but the dividend and cash evaluations, don't worry about it. And God forbid you get it, it's probably one of the experimental because that's really too hard. Okay, so now, disgorge means get rid of, right? Disgorge. So basically, a lot of times they do this. If you do something wrong, they're going to disgorge your commissions, which means take them the fuck away. Okay, that's what that means. Crowdfunding, okay? Crowdfunding is this new way of raising money that you can do what it's called, I forgot what it's called, but it's a crowdfunding regs, where you can actually raise money from a lot of people. Instead of doing a full IPO where you have them sell it, you can bring in. But here's the thing, there's limits on who can put in. If you make under $107,000 a year, you can only put in like $1,000. If you make over 107, you can only put in like, I think 10,000. It doesn't matter, but crowdfunding has a limited number of people, but you can raise from a lot of people. Think of like Kickstarter. Kickstarter, you're putting it out there and a lot of people are investing. Instead of them going to like the investment bank and selling it, you're raising it through crowdfunding. There's limits to what it is. There's a limit. I think you can only raise 1.07 million, 1,770,000 every 12 months or something like that. I don't remember the number so much. But crowdfunding is about raising money from multiple people. Now, think of like Bernie Sanders in a way, that he has a bunch of little contributors versus like the big guys have big contributors. That's what it is. It's a bunch of little people doing it. Okay. And an affidavit is just like you're signing an affidavit, you're promising to do something. A lot of times they'll say, like, if you want to open a private account without your name on it, you might have to do an attestation where you sign an affidavit saying, this is me, I got that, okay? So those, thank you for bringing those words up. I'm happy to help with those. And if affidavit, if I'm doing it in injustice, I'll come back to it later. Okay. Yeah, Carolyn, do not sweat this shit. It is a small problem in a long ass career. Okay. Okay. Yeah, 70's tough. Okay. 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 I did it last week. I did it on Thursday. Watch that again. Okay. Okay. Hold on. Okay. Yeah. So this is what I tell everyone. Stay in the freaking moment. Okay. Okay. Stay in the moment. Okay. If you're taking the SIE, focus on the SIE. Don't think about the other ones. If you're taking the 7, focus on the 7, not the 66. Once you're taking the 66, you can focus on that because you're going to be drunk after you take it. So real quick, I'm going to do the real quick math, okay? Equity is market minus debit. So if you have, because it's a long-ass fucking test. And there's not all, remember, when I say this, I'm going to come back to this, to your thing, Matt. Jake, it's not that there's a lot of carryover, but there's a lot that isn't. Like, it's going to be heavier into the portfolio stuff, heavier into present value, future value. You won't have to do the math, but you do have it. Okay, so now here's the deal. If you have margin, if you get approved for margin and you think it's suitable, equity on the long side, this is what I do with my customers. Write this down. Equity, there's only like 3 formulas you got to worry about. 4 if you want to do it. On the long side, equity is market minus debit. Boom, that's your equity. Market minus debit, they have to give you those numbers. On the short side, equity is credit balance minus market. They have to give you credit and market. You have to get them or you can't do it. So again, long equity is market minus debit. Short is credit minus market. Boom, okay? That's that. SMA is always equity, which is you just got, minus half the market value, otherwise known as Reg T, okay? Equity minus Reg T, which is half the market value. And then buying power is always 2 times SMA. Those are the formulas you need. If you do them, you can get 90% of the margin questions. And yes, you can't put down less than $2,000. Okay. So if I have a market value of 50 and a debit of 20, 50 minus 20 is equity. That's 30 grand in equity. Get SMA is 30 is my equity minus half of the market value, which is 50. 30 minus half of 50 is 25. 30 minus 25 is 5 grand. That's my SMA. Buying power is 2 times that, which is 10 grand. If I have a credit balance of 50 and a market value of 30, 50 minus 30 is 20 grand. Remember, my equity is 20 grand. To get SMA, I'm going to do equity of the 20 minus half the market value. My market value is 30. It's not the credit balance, it's the market value. Half of 30 is 15 grand. 20 minus 15 is 5. That's my SMA. Okay? If I went too fast, stop, replay it, watch it again. I promise you, it's not that hard of that. And remember, if you're shorting, no matter what you do, you can't put down less than 2 grand. So if you short $500 worth of stock, or 3,000 or 3,500, you're putting down 2 grand, and then anything above the 4 grand, you put down 2,000. On the buy side, if you buy between 0 and 2,000, you just put down 100%, whatever you bought, because you can't lose more than that. Between 2 grand and 4 grand, you put down 2,000. If your market value is between 2 grand and 4 grand, you put down 2 grand. If you buy more than 4,000, you put down 50%. Okay, there's more to it, but that's pretty much all it is. Okay, hope that helps everyone. Almost did an hour. Guys, I am going. I got my wife one of those. She's out to dinner with my daughter. I got her one of those boxes. I guess it's called Send a Cake, where when you buy it, it explodes a bunch of butterflies. She kind of knows something's going to happen because she can see it. And she said she watches Instagram enough to see the videos. But let's see how it goes. Hopefully it'll be funny. Okay. And she'll be full. She's out to dinner with my daughter, so they're all happy. Everyone, thanks again. I will be on. No problem. I will be on again Thursday night. Anyone who's taking it tomorrow, I think Anna, if you better not be on here still because you should be asleep. Julissa, thank you for saying that. Okay. Everyone talk to everyone tomorrow. Please, if you like what I'm doing, hit the like. If you want vendor stuff, go down and buy my STC stuff for that, or even buy some of those books I'm putting on there. Some of those books are good. All you guys are done with the tests. Those books are some interesting books to read down there. Okay. Oh, there you go. That's right. So you're still on, but go to sleep soon. Okay, that's right. We did talk about that. And if you like what I'm doing, find Blue. Okay, Google, play the latest edition of Blue Collar Finance. Hopefully you guys have Google, and it just made you do it. I love it. Guys, everyone else, I'm going to try to do some more videos. I just did one on the accredited. I help with the 6. If you have, okay, Google, cancel. Okay, Google, cancel. Okay. Yes, Raymond, I do help with the 6. If you want, not tonight, I can do that Thursday. By the way, Jason, I don't really do a lot of options. I do that in person. Shauna, we got this. Okay. I don't really do options in here because that's the magic. That keeps me busy all day long. That's what all the people are paying the big money for. And just so you know, every one of my students wishes there were more options on the test. Have a good night, and I will see you guys on Thursday. Wash your hands.